you know, and we had, I believe we had this early morning session on economy. No markets can operate in isolation. They are always connected with economy. I thought that we will break up this discussion between broad economy, then markets, then mutual fund. From the perspective of our students understanding all the three areas. So from an economic perspective and market linkages, as we know, the impacts are largely on how the Indian economy is doing, how the global economy is doing, because the economies are connected to each other. And from the perspective of uh, uh, local markets, what kind of an impact so-called global recession that each one is talking about, and India seems to be standing out very differently. So I thought we begin that with our view of our panelists, a few questions on economy, and then we move to the markets. Rajeev.
So just before our session, we had a economist presenting on the global economy in terms of the work profile that we have. Maybe the economic aspect is just 20% of our work, and 80% would be analyzing individual companies and sectors and things like that. So that is the caveat I would want to put forth before diving into this. Broadly, I think in the post-COVID period, there was this huge injection of steroids just to keep the economy alive. And now we are having that withdrawal symptom. So obviously that was not a permanent situation. I think most people on this panel are people who have been around for 20-25 years, and we have seen in mid-90s interest rates of 14% on Government of India securities. AAA rates were 18%, and AAA NBFCs were raising money at 21%. From that, we have seen lows of maybe close to 5% Lakshmi on 10-year government bonds. So we have seen multi-decadal falling interest rates. Now, what happens when that cycle completely bottoms out and you start seeing positive real rates is not something that we have experienced, any of us have experienced in our careers. We have probably read about the Volcker era where people had to raise interest rates significantly to curb inflation and things like that. So I think that is the biggest challenge that I see on the overall economic front. Coming to markets, I think personally I think we are going in for a shift where the raising of money on future promises and endless rounds of raising funds at higher and higher valuation just on the basis of revenue without any positive free cash flow, I think that is coming to an end. Some of the newer listed companies we have seen drawdowns of as much as 50, 60, 70%. I think that will be a defining trend in the coming year. So that is one segment where no profit companies will have it tough. The other segment has been the valuation creep. So some of the quality companies that around 2003 we were looking at maybe 10, 12 times earnings, 13 times earnings. Those are in some cases triple digit valuation multiples. So I think that is again something which one has to watch out for. So broadly I am seeing these trends playing out in the coming year.
Thanks. Lakshmi, take forward on broad economy related views.
Hi, morning everyone. So to give you the economic landscape where we are today, I think it's very important to understand how different economies are thinking and behaving right now. And you have to do Sri Ganesh. I know we are Indians and we love India, but we have to do Sri Ganesh with the US because at the current juncture, US is actually hogging the pole position, behaving like the Pathan of rate hikes. It has been the torch bearer as far as rate hikes are concerned consistently. Of course, there is Brazil also, but I think the one that matters right now is the US. where even at the current juncture, they are not yet giving it up as far as the rate hikes are concerned, despite the fact that the retail sales data in the US was not as great, which was released a couple of days back. Inflation is coming down, no doubt about it, but way above the Fed threshold as far as, so I think from that standpoint, looks like there will be some more rate hikes in the US. Gradual is the word, but I don't think they are in a mood to plateau out as yet. China is doing, I would say, some sort of a bhul bhulaiya act. To my mind, China has always been a black box. Whatever I read, the more I read, the more I get confused. The zero COVID policy to start with finally is giving way to we will open up, and they have been doing all sorts of things to ensure that the confidence of the foreigners don't remain the way it is, or whether it is clamping down on the edtech sector or all of that, and that has led to some, I would say, caginess as far as the foreign world looks at China, and therefore, obviously, from that standpoint, it gets to be advantage the rest of the world, including India. Japan, on the other hand, is getting that FOMO feeling. Where they finally decided that we are hum piche kyun chhoot jaye, so we will also start, and it's the first time in 12 years or 13 years they actually increased the threshold band of their government bonds. It was zor ka jhatka zor se, because that was not something which the markets were really prepared for, and they had to do, I would say, some sort of a cementing act, and they started buying the bonds. And that's why this time, if you see day before yesterday, they didn't increase the band further, which the markets were expecting. So when you see US, China, Japan, you see the economic turn of global events is not happening in a unilateral manner. And that is how it is, and this is the post-pandemic world that we are staring at. And that brings me to India. India is saying for everything, US might be the Pathan, but I am the final Shahenshah. I think that is where India is kind of moving towards. In some sense, we have not behaved like US, because that would tantamount to some sort of a Begani Shadi mein Abdullah Diwana kind of a feeling, because US has to hike rates because, given the fact that their inflation threshold to where they are, there is a significant gap. Whereas in India, we are already below that threshold. If you know, India's threshold is 4%, give or take 2%. And therefore, I would say that, and we are well within that band right now. And looks like for FY 2024, ceteris paribus is the caveat, but other things remaining okay, we should be broadly in that range, give or take 15-20 basis points. So I think looking at all of this, and if I kind of tie that into the market, there is no doubt that India has got incrementally expensive because of all these reasons, confidence factor, reallocation, all of that. Some bit of that could see some adjustments in the coming year, which is FY24 or CY 2023. But I think, and therefore that Sartaj or that Shahenshah status from a market standpoint probably could get challenged, because there are, and when you look at it from a global allocation perspective, once you tie the macros to the market, they are all opportunistic asset allocators. So I think some of those trends is what we could see from a macro perspective tying into the markets in 2023.
So Ramesh, if you can take this forward and also give some views on assessment of Indian growth versus the rest of the world. One is looking at recession and one is not sure in India.
Hello. We are, as Rajeev said, we are more equity people focus on businesses and less on the economy. That's our role is. So I tend to understand the economy by talking to companies and seeing what they are seeing in their businesses. My assessment of the state of the economy comes from bottoms up, on-ground feedback on what is happening on the ground. So 3-4 years ago, you had seen broad-based weakness in the economy, even just pre-COVID also. Yes, Indian economy actually was pretty weak and it went bottoms up. Hindustan Lever was talking about zero volume growth. Hindustan Lever talks about zero volume growth with their as basic as a staples consumption sector. You had metal sector which was generating bankrupt companies. Infrastructure had a lot of legacy problems, with promoters, with balance sheets. You had capital goods sector which was dead for 7-8 years, lack of any orders, meaningful capital cycle. And another large part of the economy that was dead was real estate. Real estate was, even 3-4 years ago, it was down 4-5 years ago before that. So now when you take a health check of these sectors, and when I mean look at the company's results, when you talk to companies, and another aspect of the Indian economy that was also dead was manufacturing. Right? Services was doing well, particularly IT services there. Now when you look at this, while traditional strengths like IT services and pharma are fine, consumer India is generally pretty stable sector in India because our saving rates are pretty high. So even if incomes don't grow, we tend to consume out of our savings. But now you're seeing many companies actually have never seen better lives in the last 2 years since inception. You are seeing infrastructure, a lot of government spending happening. A lot of the past cleanup has happened through assets changing hands, stronger, new promoters emerging. Industrials now are sitting at record high order books. There is some signs of a capex cycle in India. A lot of businesses now available with industrial companies. And it looks like the real estate cycle is back. I'm not making a forecast, but initially it looked like real estate demand came after the COVID shutdown. But now many months post that, real estate demand remains strong across all major property markets in the country. In fact, prices have started going up in select markets. So bottoms out feels the economic growth today is not broad-based. I don't want to say everything is right because we're still seeing some reasonable weakness in rural consumption. We're seeing weakness. I'm talking about companies that are telling us, we now start seeing a lot of weakness in urban consumption. Definitely. So maybe the effects of inflation are playing out. There is some initial revival of manufacturing. There's in fact a lot of exuberance if you talk to manufacturing companies on their potential. And so manufacturing, it seems, looks good. And one sector in India, we are the world's largest importer of defense. It's irony that I've lived in for 20 years is we can put world-class space, the world-class space as an agency. We built, nuclear weapons long ago, and I would urge many of you who have not watched, you should watch this OTT series called Rocketry, right? The story of, anyone has watched this series? Yeah, the story of the who are the two people, who are the two boys? Who are the two boys? Yeah, Vikram Sarabhai and J. Baba, the father of the space program in India and the father of the atomic research program in India. And India invested when we didn't have money on food on a table in technology. Unfortunately, we don't enough. Even today, our investment in technology is minuscule. And while Indian companies are capable of building sophisticated defense equipment, we are not part. And the good part is this Ukraine situation is a blessing to our defense sector. Now India is forced to build our own weapon systems. And I'm sure in the next decade or two we are going to build everything happening in India. So I see a few good signs. Sometimes crises are blessings. Eventually they are blessings for you. And I think we're doing reasonably okay. We are a relative oasis. We will get impacted by the global economy, but I would say in India, if you're growing at 6.5%, 5.5% is a recession. Let's understand. Recession. So in India, recession, the technical definition of a recession is negative GDP growth and job losses. In India, lower growth rate feels like a recession. That because now for 30 years we have a base expectation of growing at 6 to 6.5%. So when we talk of what happens to global recession, probably will go down by 1%. But because of the kind of momentum we have as a country, and I think that is going to impact. I think this time the impact on financial markets will be different. I'll talk about that later.
So one small, any of you can answer is, if before we actually get deep into the equity markets and mutual funds. Is about last 30 years we have seen a 4.5% depreciation of the rupee because that was a differential inflation. Can you hear me? Uh, 20-25 years, we have seen a 4.5% depreciation in rupee because that was the inflation differential. Now, first time, as economists, many people are confused that we have a negative differential. Now, in that scenario, and services being a very large component of our listed market as well, how is it that going to impact, begin with the view on the currency, and number two, how is it going to really impact the performances of many of the companies?
Company part, you can talk, currency part, I'll talk, but the thing is that it's a very valid observation, and this, in my own career also, this is the first time I'm seeing that the Indian inflation is visibly lower and trending lower compared to the US inflation. Of course, one can debate how soon it will last, etc. But I would say just enjoy the party till it sustains. But the key thing is that what implications it has for the rupee. The first and foremost is that historically, if you see, and I know that if you torture data, it will confess, but we are not torturing data over here. What we are saying is that if you historically look at a block of 3 years on a rolling 12-year, 15-year basis, any time we've seen a currency rout, and this 10.5% in 2022 was one of the worst that we saw for the currency. Typically the future years or the year immediately which follows that is not such a bad spell. So that is number one, it's slightly more near term. But on a more fundamental basis, if you see our dependency on Russia, for example, to get our crude imports, that number is steadily increasing, which means that crude oil increasing is obviously there is vulnerability, but the vulnerability degree is receding. So that is one big positive. And the second thing is that today, if you see, we are from net importers, we are now net exporters of mobile phones and toys. Another very big positive. Of course, gold will remain, electronics, some bit of it is getting resolved for coal. Non-oil, non-gold imports, coal is another very big component. We have to resolve for some of this. But on balance, if you see that, looks like the current account deficit for the coming year is likely to be visibly lower than the CAD for the previous year. That is number one. And if we resolve for some bit of the trade deficit, we run a massive trade deficit with China, for example. If we resolve for some of this, which I don't want to get into PLI, etc., but once that happens, some bit of that resolution will happen. I would say the nature of the rupee to depreciate may still remain, but the intensity could be much lower. I think that is what is a very important point we need to think about. Very near term, it's also important for us to know and note that we expended a little under $100 billion last year just to defend the rupee. Of course, that number has come down to close to $70-75 billion because we bought dollars also when the reverse started. But that's also equally important that your Brahmastra for the country is the foreign exchange reserves. So if there is going to be another Kurukshetra on currency wars which will keep recurring in a block of 2 to 3 years, your Brahmastra should be handy, and that is the foreign exchange reserves. So therefore, even if the macro substantively improves from the current level, which I really have my doubts, on a relative basis we'll do better, but it's very difficult for us to be a naturally appreciating currency because the twin deficits will remain and we need to shore up our foreign exchange reserves.
Thanks. Rajeev, you have been amongst the early, perhaps, institutional investors who looked at global markets. And we would like to know your style for both local as well as global markets.
Sure. So, the first thing when I typically get asked this question is India, the listed companies in India, are they local anymore? So today when we look at companies like Wipro, Infosys, TCS, the Accentures and Cognizants are having the same business model. Or when you look at, let's say, Reddy's and Lupin in India, a Teva or a Mylan will be a similar thing, meaning make generics in a low-cost country, export it to the developed world, or do IT services offshore and service the advanced countries. Today, whether ONGC is a company listed in India or whether you are buying ExxonMobil, the underlying drivers are more or less the same. So, it's not that just because Indian GDP is growing at 8%, ONGC will suddenly produce more. It depends on geology and their oil fields. It's not that their oil price will be different because India is growing faster. So all your oil companies, all your metal companies, global commodities follow more or less the same cycle. Today, when we are buying Tata Motors, willy-nilly we are buying Jaguar Land Rover. Or if you were arguably, if you were to go to Japan and buy Suzuki, you not only get 50% ownership in Maruti in India, you get 100% of the royalty that Maruti pays, plus you get the battery plant in Gujarat, plus you get the two-wheeler business in India. So I would argue that Suzuki Japan is more Indian than Maruti in India. So firstly, I have a small pushback against this local versus global. Today everything is global, one way or the other. The other factor that a lot of people get excited about the fact that GDP growth in India is higher, so arguably returns from Indian stock markets will be higher in the future. So just a simple Google search after this event is over, find out the correlation between GDP growth and stock market returns. It's 0 to negative. Okay, so this may come as a surprise to many people. So China has been growing GDP very fast, right? How has China done as a stock investment destination? Not so well. So a lot of other things matter, starting valuations, GDP growth converting to profits. So almost 6-7 decades back, the father of investing, Benjamin Graham, had this one simple statement. Obvious prospects for physical growth do not translate into obvious profits for investors. Let's take an example. If more passengers fly in India, does that increase GDP? Answer is yes. Does this mean more profits to airline shareholders? No. So, panelists have been old enough to remember names like East West Airlines, Damania Airways, Modi Luft, Air Sahara, Kingfisher, Jet Airways. So many bankruptcies. Telecom has been a shining star of volume growth in India. Has telecom been a great investment destination? Answer is no. So again, when people look at investing, I would urge people to look beyond GDP growth or the cookie cutter approach saying India is growing fast, so invest here. And without belaboring the point too much, it is said that diversification is the only free lunch available in finance. So when you have some of your investments in global companies, you get some protection against India-specific events, whether positive or negative. So when a surprise corporate tax cut happens in India, you don't participate. But at the same time, when a demonetization happens, you don't suffer the downside. So your portfolio volatility comes down without bringing down the investment returns.
So can we say largely it's a bottom-up kind of
Absolutely. So although India is a great listed company place, the exchanges have a wide diversity, maybe thousands of companies listed here, there are some key gaps in India. So you don't have the equivalents of Microsoft, Apple, Tesla or Google or those kind of companies. You don't have the innovator pharma companies, those are largely Western. Even the upstream energy, largely it's abroad. So on the bottom-up basis, you can identify some other opportunity sets which are not available here, or you could actually evaluate. Is it better to buy Suzuki in Japan or Maruti in India? So on a bottom-up basis, one has to select your investee companies.
So Ramesh, are you a bottom-up investor or a top-down or a mix, or how do you decide? How do you create a portfolio?
our investment approach has been completely bottoms up. In how we invest. We actually try to ignore the macro as much as possible. Except the fact that we are not going to have an handle on macro. We are aware of the macro, but don't have active views on macro. But actually, are very bottoms up. If you build a solid portfolio of good businesses, some of them, actually individual businesses will figure out a way to weather the macro, whether they'll be able to, withstand difficult times and grow stronger in difficult times, and of course then participate in the opportunities in good times. So our construction is actually bottom up.
Any sectoral views that you can share with us in terms of your how often you change your views on sectors, and or it's not sectoral?
Yeah, again, sectors is again usually quasi macro. It's another way of macro view representation. For example, even in the worst sector, if a sector has bad prospects, you will find million companies, right? So if you're truly bottoms up, you actually ignore the sector also, because sectors are just another like for example, people are talking of US, recession, right? And the macro thing there is don't own US. This pharma is not so sensitive to the recession, so IT is sensitive to recession, right? But actually, in fact, some of the fastest growing companies in India in rupee terms over the last decade are IT services companies. Even today, actually, if you look now, also, the number of mid-cap companies which are growing in rupee terms, the fastest. So you can still find that great company which will outgrow, because they are not even 1% of the market, global market. See, when you are small part of something, like if you're a very small fish, you can't blame the ocean. It's your capability on what you can do. Only when you're a big fish, then you can blame the ocean, the waters. So there's always bottoms of opportunity.
So India, about 20% is owned by foreigners. So how is their behavior? Because from the industry that all of you come from, there is a large change which has happened over the last 5 years, where FI sensitivity seems to have come down. Is it true, and what's the way forward that you see?
Yeah, so I think that's a very interesting dynamic that is playing out in the market, and I'll tell you what has happened is, and Rajeev also will remember, the previous decade, the 2000 to 2010, when FIs had pulled in India, we would get demoted. Our markets would get demoted. Even if our economy didn't get too much impacted, our markets would take largely. In fact, India was a high beta for global markets. And the reason was that Indian investors were not providing risk capital to Indian businesses. Indian capital, first it was small, it was going into real estate, it was going into gold, it was not supporting risk capital. What the dynamic that has changed in this decade, and particularly post-Nirman, it has accelerated, is now your significant regular flows into equity markets. And they take three shapes. The first is what is called the mutual fund, but where the important number is the SIP book. The SIP is a systematic investment plan. The average ticket size is 3,200 rupees. And yet 13,000 crore comes every month into the SIP. This number 10 years ago used to be less than 1,000 crores. So just look at the CAGR it has grown. Number two dynamic that has changed is the insurance sector. Again, private insurance was very small. Now $10 billion of equity comes into the market through the insurance sector. And number three, globally pension funds and provident funds invest 30% of their portfolio on average in equity. In India, till 7 years ago, provident funds were not even allowed to invest in equities. Now also their exposure is in single digit. In fact, now they're working on proposals to let them increase the exposure. It's 50%. I'm saying actual exposures. Actual exposures are more in single digit. It's actually the way it gets calculated is 15% of the gross investment that is done. It's not the net investment. So if they sell something and reinvest, it has to be 15% of that. So you understand the technicality there. So it's still a single digit. ESICs we just allow to what you call invest in equities. So now you have this $35 billion of domestic savings that come into the market. Just do the numbers. This is about 240,000 crores. 250,000 crores. We have about 250 trading days in a year. So 1,000 crores per day comes to the market. And this is been very steady. And mind you, SIPs might go up or down. But insurance flows, provident fund flows, those are not going to change. Because whether we like it or not, our PF will get deducted from our salary and is going to go, right? It is going to get invested. So those are very systematic flows. So now a large part of the risk capital in India is being provided by Indian investors. And number two, the second dynamic that has emerged in India is the private capital markets in India have actually become bigger than public issues. If you look at the IPO issuances in India versus private equity and venture capital investment, those have become much larger. 20 years ago, private markets were virtually non-existent. So that now we are no longer dependent.
So we'll come to private markets in a minute. I have some thoughts on it. I want, so Lakshmi, when you're looking at from the biggest, one of the challenges which I see for the industry as an outsider is the alpha. Now the question, and which is taking up from just now what you mentioned, which is the fact that large retirement corpuses are finding their way into the markets, but they seem to be finding their way into the markets by way of proper indexes. Most of the money is actually, if I'm not wrong, is actually getting into the index. Now the question is, as an industry, mutual fund industry, we would have about 20 and odd lakh crores of equity investments, and I would say, based on the data that I have, correct me if I'm wrong, is around, at least in the large cap space or large or mid cap space, one is seeing about 50, 60, 65% of underperformance to these benchmarks. Now, how is this sustainable? One. And number two, is there something wrong with the index or is there something wrong with the fund management? Either of them.
Most controversial.
I can ask all these because I used to be a fund manager. Now I'm not there.
So it's a very, very controversial topic that you have raised, and I think I'm sure Rajeev also has some thoughts on
There is
this.
no controversy. This is a reality. One has to address it, saying that what is going wrong? Is the fund manager problem or the index?
No, my own take is it's not a fund manager problem. Number one, and of course, Rajeev, you can add your two bits to this, but let me just set the context right. There are a couple of things which are happening. When we are looking at underperformance, outperformance, unfortunately, there's a lot of short-termism which is coming in, and there is a tendency to track fund performance over very short term, and I would see even 1 year as very short term. For example, barely anyone could really outperform the index last year. Barely. I mean, there are exceptions, I don't deny that. For everyone, the pole position is Nifty. Okay, Nifty, you underperform, what have you done? But the key point is, look at the kind of polarization that was there in Nifty in 2022. It was humongous and how? Pretty much similar to the world, but the reality is that, so the short-term bias or the recency bias tends to seep in when you start doing this kind of a comparison. Though I must hasten to add that even over slightly long-term periods, the tendency of alpha generation and consistent alpha generation has happened in mid and small caps, and the non-large cap or the bluest of the bluest companies, given that incrementally it's getting to be a daunting task to do a consistent outperformance in the large cap space. That's number one. And having said that, we need to understand that whether it is transaction cost, whether it is timing, whether it is that small cash that you keep, in the funds for open-ended funds to meet inflows, outflows, largely the outflows rebalancing, etc., or the way the index is rebalanced, or maybe some of the stocks or groups that come into the index could be inherently quite expensive, and that too, when you are doing a when you do a bottom-up stock picking and you are a GARP follower, both at a reasonable price, some of these things are getting incrementally, playing in the large cap composition. Predominantly I'm saying large cap because I would still say there is not so much of a debate whether or no mid and small caps are generating alpha. Again, I'm not getting carried by the last 12 months, I'm talking about the last 5, 6, 7 years where there is consistent alpha generation. So I think the way out, therefore, is not to shun away saying that, fund managers cannot create alpha. In a country like India, we are firmly of the belief that there is alpha generation. In fact, there was a very recent study which was done in the US, where even there has been an outperformance right now underway because of the bottom-up stock picking, where the US managers have created alpha over and above S&P, where the typical tendency was hardly 10 to 15% of the fund managers there outperform the index. So I think the way to play out therefore would be to look at complementing passives in your portfolio, and the passives largely to do with two sets of passives. One is the large caps, which is what most of the global asset allocators are doing. Of course, some of them do cherry picking, where they are just index huggers. And if you see MSCI has about 15-16% odd weightage to India. So one, you do that. And the second is get in some bit of factor investing when you are making your investments, which is low vol, momentum, quality. There are 5 or 6 factors, for example, that we track. And we have seen that consistently in the passive space also, when you use factor investing as a way of deployment of your capital in that space, there is a tendency to show some performance. So I would say, I don't think it is a fault of the fund manager, and obviously being a money manager myself, done enough and more analysis to do all of this and reach to this conclusion. The truth, as I said, lies in a combination of all of these factors. And there is a way and there is a desperate need to obviously have that stock picking approach, because all and sundry the kind of sector rotation that we have seen is going to get more crunched. Typically when I talk to investors, I say in a block of 3 to 5 years, you'll see at least 2 interest rate cycles, at least 1.5 to 2 sector rotations. What is now happening is, in 1 year, most of these sector rotations are getting crunched. And how? This is the new brave world, we have to live with it. But to say that the fund manager is at fault, I think that which is where some of them, as I said, I was last week in another debate where this was the classic case in point, which is why I said it's a little bit of a controversy. Rajeev, you want to add something?
It's a pet peeve. So, do you want me to really go at it, or we can move on? If you, yes, okay.
The other before we open up for questions, one other thing, as an investor, when I am getting into the markets, and as all of you know, today we have got more investors in the equity market through mutual funds than direct investors. So the industry has done a phenomenally well in popularizing the entire culture, long-termness of investing in equity. It's an amazing field. One of the things which, as an investor, when I look at, is I realize that over a long period, between 15 to 25% of my income is going to that middleman, which is the distributor. So that is something which is scary, and that is something as investors, when they become financially mature, they want to identify this. There's 15 to 25% going away. So is there a way out? And is there how? What is the industry? Anyone, if you can take this call, because 15 to 25% of my income is going in the hands of somebody who is just pointing a finger for me to invest in that sector.
Okay, since I have the mic, I will go ahead. Let's talk absolute amounts. So if you are a billionaire, you should definitely not go for the regular plan. You should hire a family office or investment advisor who will work with you for a flat fee, and you save on the distribution cost. If you are tech savvy and if you know your way around, go to any of the AMC websites or the aggregators like Grow, Kuvera, or any of the ATM monies, ETM monies, and you can do it in direct plans. If you are buying a very, very simple product like a liquid fund, you don't need advice, you can go and save on the distribution cost. If you are an architect, dentist, lawyer, and have absolutely no clue about financial markets and are going to invest 10,000 rupees and you want to fill a paper form and write a check, even if your distributor gets 1% on 10,000 rupees, on the absolute basis it comes to 100 rupees. So, barring the very, very large distributors, the large banks or foreign banks or some of the large distributors. Actually, bulk of the distributors barely eke out a living doing this work, and they are effectively guiding people in the right path. So Charlie Munger has said this: show me the incentive, and I'll show you the behavior. Right? One could theoretically cut out distributors completely. What will they sell? They'll sell Ponzi products, they'll sell cryptos, they will sell some very high commission insurance products maybe, or something else. So today when banks work on 3 to 4% net interest margins, AMC's indirect plans work anywhere from 10 basis to 50-60 basis. Distributor commissions on debt products are maybe 30-35 basis, on equity maybe 80-90-100 basis. It's not as lucrative as it sounds, and I would still say even a regular plan mutual fund scheme would be more beneficial to an end client as compared to a bank deposit or a insurance product, even after the cost that is there.
And Sandesh, if I may add to what Rajeev said, the thing is that SEBI as a regulator recognize that there is something like this happening, which is why in 2019 mid they came up with a regulation saying that you decide whether you are an MFD or a mutual fund, which is a mutual fund distributor, or an RIA, which is a registered investment advisor. What is the difference? There is one which is a product push where you get incentivized by the manufacturer, and the other thing is a proposition creation where you get incentivized, where you charge fees, like the way an asset manager does. You charge fees from the customer or the investor. The unfortunate part is that everyone loves Googling. I have cough cold, what do I do? Google will give you answer. Maybe now some of you or some of us are using ChatGPT. But the reality is ChatGPT also has a disadvantage, which is why then you can check it out. Say Mike's mother had 4 children, 3 of them are ABC, who's the 4th? And ChatGPT says I don't have sufficient data to give you the answer. And all of us know the answer here, we'll say it's Mike. So therefore I think the necessity of the Sarathi in the life of an uninitiated investor, extremely important, 11 on 10. In the life of people like you and me, Rajeev, Ramesh, not so important because we're already initiated into the world of finance and we eat, drink and breathe that. So at best we require some nudges here or there. And then there is this entire country which is saying that the mindset is so short term in nature that you require somebody to constantly nudge you that ye karo, ye mat karo. And to some extent, I think that the longevity has got extended. The nature, even SIPs, if you see in the industry, were average were 12 months, 18 months, 24 months. Even there, the longevity has gone up. So yes, they've acted as a catalyst. One needs to reduce the greed factor, which anyways by virtue of expense ratios getting capped by the regulator, and as the AUM goes up, you're seeing that come down. But to wish away completely that the entity or the intermediary cannot play a role, that I think seems to be, given the fact that we as a country are still pulled towards bank fixed deposits, which is, I call it the Chumbak effect, the magnetic pull. Every other financial product is literally a push product. So in that kind of sense, but I think the trend that I see, and this is for the industry at large, is towards managed advisory, managed discretionary assets. It could be non-discretionary also, but that is the way it looks like next 5 to 7 years India will start moving towards.
So, Ramesh, we have a reasonably young, impressionable minds here. You touched upon the private markets. Yesterday, Go Mechanic fraud has come out, and massive amounts of frauds are coming out in wherever financial markets are there. You have an FTX happening every month. We are hearing some new name or other, and significantly, we are seeing that many of them in the private markets. Now, lot of money is getting into the private markets from a governance perspective for this age group that we are addressing. One of the even becoming a consumer bank and trying to ensure that you don't undertake mis-selling. What kind of your thoughts are in terms of what you see right now in the private markets and all these kind of things. So what reminded me yesterday was when I was sitting in, I think me and Lakshmi in the trading room when Ramananda Raju came on CNBC saying that I'm riding a tiger and I have created that fraud. Now all that things are continuously happening. So how do you as an investor look at it, and what kind of advice you can give it to the audience?
Sure. So first, I think startups and venture capital are necessarily part of the economy. In fact, it is really the real risk capital because, in fact, public markets are serving less than need of risk capital. So every startup is an experiment. Every startup is an experiment. When you went to your chemistry lab and mixed two things that you didn't know, most of the time, nothing happened, right? Nothing fruitful came out. Once in a while, you also had a fire, right? But if you do enough experiments, you will get lucky or you will have a bulb you'll light somewhere. So I think one of the most interesting dynamic of India in the last decade is this emergence of venture capital, angels, startup. It is like funding thousands and thousands of experiments. Most experiments in science fail. That is the DNA of experiments. But when the few succeed, remember, Google was a startup, right? Apple was a startup, Facebook was a startup. All the defining global companies were startups, right? Something brilliant will come out someday. So let's not talk down. This is a necessary part of the system, and failure is a feature of startups. It's not a problem. It's the problem. The second question is on governance. I think governance is where the issue is really. See, first of all, fraud, the idea to make a lot of money in the short term is a basic human weakness. It is there, it has been in the past, it is there today, and it will be there in the future. What can change is the rules can get better, like in America, that if you get wrong, you go behind the bars very quickly. In India, even if you do a fraud, you'll sit in your home and enjoy your money. And in fact, you can take the citizenship of another country. And by the way, I just want to point out, we've seen much bigger frauds in the banking system than any other part of the financial system in this country, right? At a huge scale in the last decade. So it's a human pervasive problem. I think what has happened in startups is the failure of governance, both particularly from the investors themselves, because they became greedy. They wanted to get 5x, 10x in 1 year. See, when at least in public markets, we're very happy if we get a 15% return. We're extraordinarily happy all along the way. But they wanted 5x, 10x. Everybody was in a greedy business. You closed your eyes, and I'm sure again it's going to happen. And this time somebody will say, I'm going to set up an AI startup. Again, money will go the same way. So it's the greed that you stop looking at what is there on that, and that's a failure. And I think corrections will happen. Just like every crisis creates an opportunity for reform, but I think it's a big failure of the big venture capital investors. Particularly, I'm disappointed with the large institutions. I don't want to name them, but you know the obvious ones, the global firms that are being leaders in venture capital, and they've made a mistake. For your career, I can tell you is that ultimately any business will succeed and scale if you create customer loyalty. In your life, you have to evaluate any business. It should be only lens for customer loyalty. And customer loyalty with unit economics. That are you able to get loyal customers where you are able to make the decision? If you can do that in your businesses, that is the business that will become big and valuable. Otherwise, you can. I always say that if you start running a discount outside, right? Like for example, in financial services, people often evaluate financial services by loan growth. If you start lending crazy money, there will be long queue outside the door. So growth is not important. First, what really matters is unit economics. What Rajeev said, the important line. Why GDP growth is not correlated with equity returns? Because before growth, what matters in businesses is return on capital employed, which is a proxy, which is another name for unit economics. Growth is only valuable if unit economics are positive. if unit economics are negative, then actually growth destroys more value. So remember, long-term value is only going to get created if you create unit economics, and which comes from the fact that you all longer term have a loyal customer.
So one last question for Rajeev. About 3 years back, SEBI changed its guidelines, which allowed a loss-making company to get its listed. 3 years back. That was the first time when Zomato got listed. Till that time, I think there was a minimum profit requirement, blah, blah, blah. Now, with so many of retail investors coming in the market, we have got some 3 crore plus new demat accounts which have got open, so much money moving into the mutual fund industry. Have we really, when you talk about unit economics, which doesn't exist in many of these recently listed blue tech companies? Your thoughts?
I don't have a clear answer. So again, I know that in the mid-90s you were the merchant banking division and coming out with IPOs. That time we had, prior to that, we had controller of capital issues. We surely don't want to go back to that era where there is some regulator somewhere who sits with a table where certain numbers are input and then tells you that this is the price at which the company should get listed. So that is one extreme. The other extreme is free for all, meaning you have prospectuses which runs into thousands of pages. Merchant bankers say we have disclosed everything, now it's up to the end investor, and then things are overhyped and people go into losses and stuff like that. So that's the other extreme. I think the correct path is somewhere in between. I would think there is some merit in restricting the access to loss-making IPOs to people who, in theory, should know better. So, in that sense, have some cooling period where retail is not drawn in and things like that. But again, as I said, in theory, because some of the so-called smart investors have also got fooled in the current madness. So, unfortunately, I don't have a very clear answer to this.
So, I think thank you all of you. I will now open it to questions, Q&As from students and viewers.
Actually, I just wanted to discuss. I think it's very popular among students for some reason, zero data. Extremely popular, zero data. And what is it that has charmed them? And this what is it called, small case or something?
Small.
Yeah, that has really caught the attention of
Before that, crypto.
No. Our students don't take that much risk. Maybe a few of them, but most of them are risk averse.
Zerodha is just a platform for you to access stock markets. Basically the technology is seamless. And a number of brokers, by the way, have implemented on the same technology. And basically they more or less bought commissions for cash trades close to zero. So it's basically technology in the last 20-30 years has made the cost of investing very low. The ease of investing has improved a lot. The cost of, people forget there used to be standard brokerage of 1 or 2% 20-30 years ago, right? Now actually for cash trades, there are a lot of discount platforms where you pay zero brokerage. Only you pay for FNO trades. So the ease of investing has improved a lot. The whole customer onboarding experience, the trading experience, the settlement processes. Again, this was a nightmarish experience itself, the whole gamut. But that does not mean investing has become easier. I would argue that the ease of buying shares has become easier, but investing has become tougher. Because markets with a lot of information coming in incrementally keep getting more efficient. So just because you can buy shares does not mean you can invest better. Investing actually has become tougher over time. That is one perspective. On small case, it's a very interesting product, I would say, at a concept level. That the idea that you can create many things around, and people have made some crazy things like companies which will benefit from Olympics, right? Gold medals, it is fashionable, right? It's an innovation in a way that it works at a retail level because you do traditionally people did broader products like banking fund, insurance fund, consumption fund, different pharma funds, IT funds, and all at a very high level. And now you've got very granular, where you say you create a portfolio of companies that will benefit from EV boom in India. You have EV small case and all that stuff. But mind you, the problem here is you don't know the quality of people who make this small case. So effectively, you're getting advice. How much that advice is getting monitored? What is the quality of that advice? And if you just read the papers today, you can see the conflict of interest at work. You just pick up today's paper, on TV channels itself, right? So you will be cautious about what are the credentials of the people who make the small case. I'm sure there's some very good at what they do. It allows some investors to scale up their investment management business without investing a lot of capital and build credibility. But the problem with any good idea is there will be no bad apples that are going to come to the system.
Good afternoon, Sumit Deshpande here. Thank you so much for joining us today. It's been a wonderful session. So my question was regarding something that was touched upon during the discussion with respect to FII sensitivity. So last year we saw a lot of money being pulled out. Do correct me if I'm wrong. About 2 lakh crore was pulled out of our entire economy. And if I am being correct, then the domestic institutional investors essentially held them up. So when you have seen that amount of money being pulled out, what is your take as key decision makers in investment? How do you see that, and going ahead, do you think we'll achieve some form of independence from this, from our dependency to FIIs?
My quick take on this is that I think our dependence on foreign capital versus the previous decade is very different today because there is a certain automatic flows that's coming through insurance and provident funds into the markets. SIP book, despite all the volatility is growing, that may change. There's also a fair amount of SIP cancellation that happens. But still there is a tide of money, and interestingly the tide only grows every day. And it's interesting because we're all part of the mutual fund industry and end up meeting a lot of investors on the ground. It is surprising how deep the equity culture has gone in India. You can go to small towns and you will have advisors who are managing hundreds of crores of equity portfolios. So the idea of equity culture is going very deep into this country. And I am seeing personally that people who used to earlier say invest only in real estate, right? Now, or then of course invest in the stock market directly are now coming through different properly managed fund products. So I think the sensitivity, I believe, has gone down. That does not mean we are decoupled. Maybe coupling has become slightly weaker.
I also want to add a couple of more things to this. One is that the dependency, of course, both Rajeev and Ramesh have discussed, which seems to be a trend which could continue well into 2023 or FY 2024. The key reason being, as I said, when globally you're asset allocating, you are looking at geographies where you get relative value. Why is the Golden Dragon Index up nearly 40% and India is nowhere near that? I'm talking about the last 60 to 70 days. That's because you are looking at asset allocation graphically, and there is a premium that one likes to pay for India, which could be what, 40% premium, 35% premium. Today we are well above 7% premium. So when you're globally asset allocating, you will say that why not China? And I call a lot of FPIs and the bulk of them end up doing the Shamshera Act. For those who've seen the movie Shamshera, you will be able to reconcile or understand what I'm saying. So they have to do that allocation, and they are agnostic because what matters to them is returns, especially the hedge funds, for instance. The other thing you also need to note over and above what Ramesh mentioned, there is this category called balanced advantage funds and mutual funds, which play apart from fundamental, they also play momentum. So you are actually asset allocating. So at the peak, when the markets corrected March 2020, you saw most of these balance advantage funds have 75, 77, 78% equity, which is now meddling at around 47, 49, 50% equity. So there is that dry powder also waiting to enter the markets when you see the side of a correction. So what is happening is there is a auto hedge mechanism, as I call, which is DOT has an antidote, which is getting built into the markets. So what you need to focus on also as practitioners, as investors also, that while these capital flows are important, it's not a do or die situation. It's good to have them, it's nice to have them. You see some of the prominent companies in India are, though they are domiciled in India, the foreign ownership is pretty high. So it's not that they're not required. But despite all of this, 1,60,70,000 crores of net sales negative that we saw last year, you still saw the pole position being taken by the banking sector, led by public sector banks. And the reverse is true probably for the IT sector. So I'm saying that the combination of this dry powder at any given point in time, the dry powder available between mutual funds in the industry owning on an average 5 to 6% cash, which is not desired cash, but that keeps happening because of inflow outflow and some bit of calls that they want to take. The balanced advantage fund on an average sitting on 45 to 50% non-equities, and of course these terminal benefit funds are a very strong shock absorber if we believe or if we think, I don't know it will happen or whatever, but assuming this trend extrapolates well into 2023. So I think the dependency factor was long broken. Not decoupled, I do agree, but the fact is that we don't need to excessively get bothered about that number. It's a hygiene, it's a necessary condition, but not a sufficient condition.
Thank you so much.
Hello. I have a question to you that you touched upon the SIP growth. Okay, so I have seen the data which says that SIPs for the 5 years, 60% of SIPs will be cancelled. So such SIP growth book, for example, e-stock market right now, people are more into trading. The retail investors are more into trading. And they've been observing the shock by the expiries at the current level. But how long it will take? It's going to take for the SIP book to cut down. Like for instance, 60% of the SIPs right now are cancelled within 5 years. Right? If the SIP, new SIPs books is being reduced, and at the same time the 60% increases to 70-80%, will it impact the equity markets as aggressively as it should be?
See, the fact is true that you see significant SIP cancellations, and that's unfortunately part of the SIP. Despite the fact that people take up SIPs, they end up cancelling them all. But considering this cancellation rate is already at 60% for 5 years, incremental change won't be very big. And by the way, the real two big drivers which are on a continuous growth momentum, considering Indian economy grows, is the provident fund flows and the insurance flows. And the provident fund, they're trying to increase the limits. Now they're trying to move for a 25% limit. So if those limits get increased, that is a perpetual annuity flow into the market. So those are not vulnerable, and those will keep growing. So at the same time, I think FIs are less relative, important to Indian economy now. And don't think of FIs as smart money. Let's get this right. Yeah, don't think of FIs as smart money. I can tell you, they're probably good at larger global asset allocation, but beyond that, when to invest in India and what to invest in India, often many of them don't have any clue. They're not based on the ground in India. And I'm telling you because we are one of the largest FPI investors in the country. So that's the perspective I want to give.
And if you exclude for the SIP numbers, look at month on month, the net sales are already negative for the mutual fund industry. So it's not that.
Yes, sir. So my question is regarding the mutual fund market. As we have seen, the mutual fund market has grown a lot in the last 10 years. The major reason being the awareness by the mutual fund companies, and the other part is the tech part of it. So what do you think at this point of time moving ahead are the loopholes or the gaps that tech can fill?
How to have a switch from Reliance Mutual Fund to ICICI Prudential Mutual Fund at the click of a mouse. Today that doesn't happen. My money goes from my account, Prudential, and I have to reduce money from Prudential back to me. from there it goes to Reliance. So from a connectivity perspective, if the industry moves to this level, where the money moves directly, that seamlessness can be transformative.
Yeah, absolutely. But lot of the things which you never envisaged in the past are now possible. So the biggest and the most beautiful thing that happened to investors is you look at your cash, okay, consolidated account statement from NSD. I think that's the best thing that ever happened. So I used to keep struggling to get one demat, one mutual fund folio, one A, everything together, and then give that to your CA to file taxes or you don't track. And this is so I'm saying technology is marrying a lot of things, and you will see that, and hopefully Sandesh's wish list sooner than later should get accomplished.
So something like MF Central has come about, where on a single website you can see your holdings across fund houses, and transaction capabilities coming soon. So probably these kind of things we'll be able to do on a single platform.
Thank you.
So if I were to just extend what he asked, how much will the tech
Hello.
play a role in your investment decisions? Will it be more AI ML that will play a role in making your asset allocation or your investment, your exit strategy, or will it still continue to be more human driven, which has an emotion angle attached to it? So if you can throw some light on this aspect.
Sure, so we keep thinking about this, and I think today no field is immune to the march of technology. That I think is clear. So even let's say surgeries, you'll have robo surgeries coming in, or we've seen let's say chat GPT writing a legal brief or writing an essay and things like that. AI and ML, in fact, I've been so scared about it. I actually went to Coursera and did Andrew Wang's machine learning and AI course over 8 weeks. I think the prerequisite for AI to make a big difference is that the environment should be somewhat stationary. So, for example, when we talk about AI making rapid strides in English language, for example, the rules of grammar don't change very frequently. Now, in finance, what happens is many times you keep seeing things which do not occur regularly or which are completely new. So, negative interest rates on sovereign bonds is not something that I was taught in finance when I did CFA or chartered accountancy or things like that. So, in AI, one of the big challenges is that it many times finds false patterns. So there is in sample, it works, and out of sample, which is when it tries to apply things in real world, it blows up. So we have had very successful people like Jim Simons and Renaissance Technologies who have done pattern recognition using statistics and been very successful at it. At the same time, of the same vintage, probably you have seen long-term capital management where the people who actually invented the Black-Scholes formula, they were running it and they blew up very, very dramatically. Some of the biggest quant shops, and we keep tracking their research, so EQR and stuff. Research is very interesting, makes fun read, but the results have been meh kind of thing, meaning other people, non-quant also are getting those kind of results. So that's where I stand, unless people have some different opinions.
No, extending this question, what he asked about technology, I think in Bangalore there are a lot of startups, they call themselves robo-advisors, and they have adequate AUMs. So what is your take on this marriage of technology and portfolio advice?
So I'll come to that, but just 1 minute on your question is that, for example, 5 years back, as part of our team on the research and fund management, we never had a data scientist. Today we have one. Does it mean that entire fundamental is getting replaced and substituted by his or her output, and therefore it's not that slam dunk? So there is a coexistence of the quantitative analysis that one brings to the table, and you add that the overlay of the quant on the fundamentals, and that is how there is a happy marriage in the investment world. Because I completely agree that algos can kind of vitiate the entire picture, but long and short of it, it is important to have that element of beyond fundamental also as part of your investment ecosystem to ensure that you're not going completely awry. Ultimately, that smile that you bring to the table has to exist. To your point, I'll tell you on the robo-advisory side, two parts to it, which is what I mentioned in the earlier question that Sandesh had alluded to, and Rajeev did cover it in bits. Robo-advisory is for, I would say, non-dummies. You just require a technology or platform to execute. Pick up any website, and as I said, without getting into names, you will see ratings of these funds, 5-star. How is the 5-star derived? 30, 40, 50% return. And who gets a 2-star? 2, 3, 4, 5% return. Have you gone into the science of it? Have you gone into the crux of it to see how much of risk-adjusted return he or she has generated? Or you just get carried away by that? And when I say returns, bulk of the ratings are derived from the returns parameter and a tertiary or a tail end. So I would say in India, purely robo-advisory might not really be the way to go, but some sort of an assisted advisory could be, where you have a human element. In robo, it's completely bot-based, or you have algos which are responding to you, which may or may not really be the case. Depends, as I said, I'll go back to basic roots, groundwork. Are you a financially savvy person who understands all of it? Like robo-advisory will never work for my father. It might still work for me, but it will never work for my father or my mother, who I'm still struggling to say that, oh, you know what, you should not buy physical gold, you buy sovereign gold bonds or gold ETFs. So I'm saying that's where, so they are great enablers, but I think India needs some assisted advisory model which has predominantly tech as the base, and of course there are humans which are there to be able to take care of that aspiration.
Hello. I'm Aditya Shinde. Actually, I have a sector-specific question. So, as we all know, we are heading towards a smarter world, and by smarter world, one thing that comes in our mind eventually is the semiconductor chip. So, in the year 2021, when the Indian government had approved a 76,000 crores PLI scheme for the semiconductor manufacturing business in India, and in the next year, that is in 2022, we all witnessed the Russia-Ukraine crisis. And both the countries were the lead suppliers for neon and palladium gases that were the major raw materials for the semiconductor chip. So by looking at two such contrasting situations, where do you project the semiconductor business in India as a potential investment in the upcoming years?
I don't have a view on this, strong view in one way or the other. The thing that I know is it's not easy to set up a semiconductor business in any country. So China has been trying for quite some time now. They haven't succeeded. Taiwan continues to be the leading player. US is throwing millions of dollars on this, so they have encouraged Intel to set up foundries in mainland US. And they are also trying to bring in TSMC to set up facilities on US soil. I'm not writing off prospects of India, but even if we were to succeed, it would be many decades out. I don't have a sector or a stock tip saying this company will benefit, or there's nothing on the horizon immediately. In fact, I'm not even sure whether it will be a profitable venture. A lot of these efforts are driven by strategic reasons, not by profit motive. So, reason why US wants to bring it on US soil and China wants to create their own semiconductor companies are to have access to those strategic resources rather than have very profitable companies. So, as outside investors, I don't think there are too many opportunities.
Good afternoon, sir. Ariman this side. So, post an MBA, a lot of us. Hello. Good afternoon, sir. Myself, Ariman. So, a lot of us after an MBA would be aspiring to be a fund manager or investment advisory on an advisory board. So, what are our prerequisite skills or what upskilling should we do so that we are at par with the knowledge base that we have or we could gain?
So, any employer in virtually any field would like to have people who can hit the ground running rather than again spend 6 months training people on specifics. So, for someone aspiring to be on the research side or on the investment side, so MBA will give you a good grounding in terms of access to broad subjects across the field, meaning some little bit of marketing, little bit of HR, some of finance, some of production and operations research. But if you specifically want to get into research and investments, then pursuing a CFA concurrently would help, having a CFA charter. Also, depending on which field you want to get into, doing some actual ground work on in your spare time would help. So, just landing up for an interview saying I want an analyst job versus saying in my spare time I have covered the IT services space or I have covered the FMCG space or I have some understanding of the metal sector. That would help. If you have actually looked at some balance sheets, if you have been tracking some input prices or output prices or things like that. Any other advice?
To learn any domain of knowledge, basically learning is in 3 aspects. One is learning concepts, number 2 is facts, number 3 is practice. Right? Concepts are fundamental to the domain. In finance, what does time value of money mean? It's a very fundamental concept of finance. Facts are what is the GDP of this country, and practice is really implementation of these things. Facts will take time to know because it requires you, right? Concepts, make sure you identify the concepts early in any domain of knowledge. Any domain of knowledge, right, fundamentally has 15-20 principles which can explain large part of the body of knowledge. Fundamentally, have a very strong handle on that. And then start practicing it. Otherwise, it will be like you have read 10 books on swimming but now jumped into a swimming pool. Right? Right? So it's important to start practicing it. Practicing means not trading or investing. Start writing your research, start writing your thesis, write a report on it. When we hire people at Whiteoak, we don't entertain a resume without they submitting a self-written report or an Excel model. The idea is not we are judging that report or Excel model too much. It creates entry barrier that are you genuinely interested in something. Because if you've taken the effort to build an Excel model or write a report, it creates a bar for you that you're really genuinely interested in putting the effort. Right? And then the world is amazing in investing today. 20 years ago when we started, there was practically limited internet. Today all the best practitioners, teachers, videos, resources, fund managers, everything is available on the internet. The best investors in the world have videos, thesis running, everything is available on the internet. In fact, you don't even need to buy a book. I'm telling you, there's so much available on the internet and it's well curated also on the internet. So it's important to start. And investing is not about knowing accounting or finance. That is just one aspect of investing. You have to master a number of domains to get things right. For example, you need to have a good perspective of history, good perspective of statistics, not high-end statistics, but basic probability theory, right? Yeah. Just understand basic concepts of statistics well. You have to understand psychology, both at individual level and organizations level. And of course, then you have to know basics of different subjects like marketing, technology, supply chain, right? So it's a very multidisciplinary body of knowledge that you need to get hands to learn this, to get better at this.
Thank you very much. Wish you all the best. It was a great discussion. We enjoyed talking and sharing our thoughts. Thanks a lot.